Now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to The Real Investment Show. Of course, it's Tuesday as we get this week underway. Today, CPI inflation day. That's expected to maybe come in a little bit hotter than expected because of the recent rise in gasoline prices. So that could be a shock to the markets this morning. We'll see. And then, of course, we've got more economic data coming out this week as well. So again, this is going to be kind of an interesting day because of the CPI inflation report. But if you're watching the Super Bowl halftime show, there's a lot of information, a lot of commentary going around right now about during Usher's performance, they were all on roller skates. And apparently a young lady fell off the stage during this. And so there's been a lot of commentary about this. Well, she actually made a video coming out. She's got a sprained wrist. She's got a black eye. It looks like she's been completely beat up. And she goes, this is just a good word of warning. She says, I'm an actor. And as an actor or an actress, then when you're filling out, my agent told me, just check the boxes of everything. Because they'll ask you on your list, what are you good at? Can you roller skate? Can you surf? Whatever it is. Just check every box. And she goes, this is a good lesson not to lie on your resume, because the thesis is that you just check every box, and there's usually enough time between whatever the acceptance of the job is and the actual shoot. You've got time to go learn out and go surf for 2 weeks, learn how to surf or whatever. Well, apparently she got cast the day before because one of the dancers got sick. She didn't know how to roller skate, so she was not an advanced roller skater. So anyway, she's clarified the situation. So as a young person going out, don't lie on your resume. It's, sometimes it doesn't work out that well, particularly when it's in some type of athletic sport. Other thing, so Brent's been playing, so a couple of weeks ago here on the show, I was talking about that my wife and I were starting to watch the Research series on Amazon, and Brent's been running a little clip on the show about our conversation about that, saying, as boomers, we don't care about advertising because now when you go to watch Reacher, if you have an Amazon Prime account, they now are inserting commercials unless you're willing to pay an additional $2.95 a month. Well, that's now gotten Amazon into a bit of trouble. There's a class action lawsuit being filed. If you were a Prime member prior to December the 28th, 2023, there is in the contract when you sign up for your Prime membership that it says that it includes ad-free streaming for Prime users. And that's been part of the contract. And so the class action lawsuit being filed is for basically false advertising, and then also to get them to remove the ads, because one party can't just change part of the contract just all willy-nilly and not go through a reprocess. So it's going to be very interesting to see, but now there's a class action lawsuit being filed against Amazon because of these ads being inserted. And look, Amazon's just trying to make some money here. Not that they don't make enough already, but if you want to charge $2.95 a month for ad-free streaming, that's fine. Just raise the cost of your Prime memberships for new people coming in or whatever, right? So, but if you're an existing Prime member, you can't charge them. So we'll see what happens, but I thought it was interesting because we just talked about this on the show like 2 weeks ago, and now this class action lawsuit is being filed. Again, it doesn't bother me, commercials, right? They stick one commercial, in the stream. I get up and run to the kitchen, do whatever I got to do, right? Don't miss any of the show, so it's fine. All right, so a couple of things. Like I said, CPI out today. This is going to be kind of the big news. If the number comes, and so really this is kind of the way the market is going to play out today. Futures are down a little bit this morning. But if inflation is hotter than expected today, well, that may not be good news for the markets, because that means the Fed won't be cutting rates as soon or as quickly as the markets would like. If the number comes in much weaker than expected, that's going to be good news for the markets. So we'll see how this is. Kind of in line, probably won't mean a whole lot. So that's where we are. So again, where we've kind of been just kind of focusing here over the last couple of days, and we're getting to a little bit more conversation about this morning, is, this market's doing great. Nothing wrong with it. So here's what you need to know before the bell. Yesterday, the markets didn't really do a whole lot. We were flat at the end of the day, kind of just chopped around most of the afternoon. It was interesting, though, yesterday morning, we opened up flat. Then just all of a sudden, right around 10 o'clock in the morning, the market just kind of took off. And we were up about 30, 40 basis points in really just about the function of an hour. So there's just a very sharp uptick in the markets, and then all of a sudden it just quit, and the market fell back down, went to flat, and stayed that way for the rest of the day. So not sure what buying program kicked in just all of a sudden yesterday morning, but it was short-lived. We had this nice little pop in the market, then the market just kind of gave it all back up, ended flat. But again, really didn't change the trajectory of the markets right now. Again, if we just take a look at the market itself, that's doing fine. The interesting side, though, was yesterday was that small cap and mid cap stocks actually had a very good day. Small caps were up about 1.8% yesterday. Small and mid caps, IWM, the Russell 2000. So actually saw a nice little uptick here. Maybe starting to see potentially a bit of rotation into those stocks as well, just from the standpoint that we've had such a big run in the S&P. Not surprising that as everybody kind of gets FOMO on that side, they're going, hey, there's some other opportunities here. So maybe we'll go take a look at that. Again, it's important just to kind of keep this in perspective. We haven't really done a whole lot in the small cap, mid cap space. Mid caps, though, themselves, if you just break out the S&P 400. Those are the mid-cap stocks. That's actually been doing much better, with mid-caps kind of getting ready to break out. And if we have to kind of pull the chart back, but again, we're about to break out again to potentially try to retake that old high that was put back in January of 2022. Small caps, a bit of a different story. Again, not performing as well as mid-caps here. So a lot of the pull in IWM has been more in the mid-cap stocks than the small caps. But again, we're starting to see a bit of improvement there. So we're seeing a bit of rotation. We'll see if that can continue to occur as, people have all kind of piled in. We're very long. If you take a look at exposures in terms of equity, very, very long in the tooth with a lot of exposure into large cap stocks. Maybe finally starting to see some of that rotation in some of the small cap, mid cap spaces. We'll see. It's a bit early here, but again, we are starting to see a bit better improvement. Yesterday was a good example of that. Small mid caps were up a good bit yesterday, while the overall large cap market was kind of flattish. So again, we've talked about this potential for rotation, and that's going to be kind of, and again, this is what we talked about yesterday, is starting to rebalance portfolios, reducing some of those stocks that are really, really kind of overweight in portfolios now because of the big advance. Now, potentially we see a bit of rotation in some of the more defensive sectors, particularly during a corrective move in the market or even a consolidation. May see some of those more defensive sectors begin to kind of pick up and make some traction here, just from a bit of a risk reduction standpoint in portfolios, because managers just like us, we can't be out of the market because of the risk of underperformance. So again, we can move sectors, though, to try to capture some of those gains and try to maintain performance, particularly if we see an overall rotation in the market. So that's kind of really just kind of the things to pay attention to. But, again, outside of domestic markets, again, emerging markets continue just to grossly underperform relative to all the other markets. Just absolutely nothing going on in emerging markets, and really no sign of rotation there at all. International's been doing a little bit better, but again, not nearly as well as domestic. So, at this point, we're seeing rotation, yes, but it's been primarily rotation in domestic stocks more than international emerging markets. Doesn't mean there's not opportunity in the international stocks. There certainly may be, but again, kind of bang for your buck side. Domestic seems to be more the place to be for right now. That's what you need to know before the bell this morning. We're going to come back and talk about today's article that's on the website, though, talking about these divergences in the markets and why. We'll kind of pick up on why we're starting to worry a bit and rebalance risk a bit in portfolios. So don't go away. More of the Real Investment Show coming up right after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Nothing sinks a marriage quicker than money issues. This Valentine's Day, promise you'll respect your lover's credit, communicate about your money, and share together our first Candid Coffee for 2024. 5 Money Habits of Unhappy Couples. Saturday, February 24th. Richard Rosso and Danny Ratliff will have money tips to help revive your financial harmony. Register now at realinvestmentadvice.com. 5 Money Habits of Unhappy Couples. Candid Coffee with Ratliff and Rosso. realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
You're listening to The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So welcome back to the show this morning. So again, over the last couple of days in this weekend's newsletter, we talked a little bit about this yesterday, that we're kind of reaching that point in the market where managing some risk a bit makes some sense. And it's interesting because in January of 2020, I wrote an article entitled "This is Nuts." And the reason that we wrote that article at that point now is because we were starting to take profits and rebalance risk in portfolios. Because again, when and I even quoted from that article in today's article on the website, it says, when you sit down with your portfolio management team and the first comments made is "this is nuts," it's probably time to think about your overall portfolio risk. On Friday, that was how the investment committee both started and ended with "this is nuts," and that was January the 11th of 2020. Of course, March was the pandemic downturn. Now, again, nobody knew that was coming, but the markets were getting overly exuberant, just a lot of FOMO, right? And, currently right now, the markets are up 14 out of the last 15 weeks, which is the longest stretch since 1972. And, and so when you kind of look at a chart of those periods where you just have these very long stretches of market advances, those typically coincide to some degree with at least short-term market peaks. Again, it's just, if everybody's bought, right, you're going to run out of buyers eventually. And then somebody's going to stand up their hands like, I'm going to sell a little bit and take some money off the table. And then you start getting kind of a wave of selling. And that's how markets work. And as investors, we often kind of forget that markets are a function of psychology and they ebb and they flow. Just like everything. Now, it doesn't mean that you're going to have this huge correction and you're going to lose a tremendous amount of money. No, I mean, you don't have to do anything. If you're kind of a long-term investor and buying ETFs, you can just kind of ride the ebb and the flow of the market a bit and just worry about the big drawdowns. The problem, as is always the case, is we just never know when the really big drawdowns are coming. There's nothing to suggest right now that we're looking at anything other than potentially a very normal, run-of-the-mill 5 to 10% correction at some point. And just whenever that occurs, it occurs. But that's why we're beginning to think about risk to some degree. But the important thing about this streak of 14 to 15 weeks is that hasn't occurred since 1972. And there was a similarity back then to today, which back in that period, we were chasing what was called the Nifty 50 stock. So, if we look back at that period, and, you can kind of see this market, just kind of this, innocuous advance. We had a bear market. And again, this is the funny thing about people as well. When you look back in the 60s and the 70s, everybody just talks about the 73, 74 bear market. What they don't realize is there were numerous bear markets before that. And so there was a bear market that actually started in roughly about 1968, and fairly big bear market. And then the market bottomed, around 1970, and then began this very sharp advance. And then in 1973, we started the 73, 74 bear market. So, this has been a very similar period. Markets rallying while the Fed's hiking interest rates, those type of things. So again, there's kind of a lot of similarities. Again, they got this Nifty 50 chase, just like we have the AI chase today. And again, I'm not saying we're going to, don't get me wrong. I'm just saying we're not about to have the 1973, 74 bear market. I'm not saying that. I'm just saying that there's a lot of similarities when you have these very strong advances that you eventually get some type of correction. Now, we'll eventually have at some point, don't get me wrong either, that we'll eventually are going to have another bear market. We'll have a 20 or 30% decline at some point. Probably not this year, but probably have that at some point in the future. So, but again, there's a lot of indicators that suggest that this market is stretched. It's a bit kind of out of bounds for its normal parameters. And so you're going to have some type of corrective action at some point to relieve that in order for the market to advance again. My colleague at Societe Generale, I've known Albert Edwards for a long time, and he comes up with some great commentary on a regular basis. And one of his recent charts was just showing the U.S. technology sector's market cap versus that of the total market cap. And that is now above 1/3 of the total market cap. And again, we haven't seen that since 2000. Again, not saying we're about to have the .com crash again either. There are differences between today and then. But there's been a lot of money piling into technology. And valuations do matter at some point in the future. So, this is going to be one of the bigger issues. If you take a look at earnings, right? So when we pay for technology, when we pay for the market, right? If you're buying the S&P as an example, an S&P index, we pay for earnings. And when you take a look at forward earnings are not growing except for the technology sector. Now, they're not declining sharply. They're just not growing that much. In fact, more and more companies right now are complaining about weaker demand, those type of issues. But technology is doing fantastic because they're the ones growing earnings. So we're chasing one group of stocks right now because they're growing earnings. The rest of the market really isn't because of the impact of what's happening in the overall economy. So why that's important, of course, is that when we talk about forward earnings expectations, and that's what we're paying for, right? We're say, okay, well, NVIDIA is trading at a price to sales of 35 times. But that's okay. This is the thesis. That's okay because their earnings are going to catch up with the stock price. Well, that's only if the stock price stops going up, by the way. All right, the stock price goes nowhere for a long period of time and earnings finally catch up with what you're paying for in terms of valuation. But that would be a very long time in this case. But that's not the way it works. We keep bidding up the stock based on this expected earnings growth that will never actually catch up with the rising stock price because we get all excited. So eventually you have a reversion of the stock price to catch down with earnings. But that's what's kind of going on. If you take a look at the technology sector EPS, it's outperforming forward EPS estimates. So, if you take a look at, trailing EPS estimates, forward estimates are running way ahead of what is happening with actual reported estimates. So again, the exuberance over what is going to come from technology earnings is far outpacing what is actually occurring. And this is why we continue to see those earnings downgrades that occur, and even 2024 estimates are still continuing to get downgraded right now. But that's why we have to have these downgrades in order for companies to beat these estimates. So what's actually happening, what you're actually paying for now, again, when you're paying for forward estimates, this is the expectation, right? This is what I think is going to happen because that's what the analysts tell me. What you actually wind up paying for is two very different things. It's like you go to a car dealership and they've got a very slick sports car sitting there. And so you buy that sports car thinking it's going to be really fast, and it's got a Volkswagen engine in it, right? It's a kit car. That's kind of what's happening. And so we're way overpaying for performance that we're not actually getting, which makes the valuation problem ultimately far worse. Now, again, when we take a look at what's happening specifically, and again, this is one of the reasons why we're becoming a little bit more concerned about the market. Technology is what's absorbing all the flows of capital. So everybody's in the technology chase. We are too, mind you. And that's why we're taking profits there. But everybody's in the technology chase. Money flows are all in tech right now, not really anywhere else. So again, it's this, everybody's piling into the same trade, which is another reason why we're sitting here going, you know what, it's probably time to take a little bit of money off the table, be a little bit more risk averse, maybe rotate into some areas that may get some cash flow if money begins to rotate in the overall market. But this is all about psychology right now. Again, it's the whole FOMO chase. In fact, if you take a look at the Bank of America, they have a global, what they call equity risk love. This is how many people are in love with equities right now. That's at a level that normally coincides with peaks in the market. And again, doesn't mean major crash. I can't relay this enough because I don't want a bunch of emails going, well, since you think the market's going to crash, I'm not saying that. We're going to have a bit of a correction or consolidation to work some of this off, right? And this is where you get the rotation in the markets, et cetera. Laggards try to catch up with the leaders, those type of things. My point is just to be a little bit cautious here because, again, we're all getting extremely excited about this market. And again, I certainly understand that. But this is the point that we want to be careful of, is that there is a time to be a little bit more risk averse. And again, we don't have to right now just sell everything. And this is always kind of one of the big problems that investors run into, which is, well, if you think a crash is coming, why don't you just sell everything and wait for the crash? Well, okay, so first of all, as I've repeated numerous times, to be clear, I don't think a crash is coming. But when we come back from the break, I'll explain to you why you don't do that, and why managing risk will work out better for you over time than trying to time the turns of the market. Be right back after the break.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Nothing sinks a marriage quicker than money issues. This Valentine's Day, promise you'll respect your lover's credit, communicate about your money, and share together our first Candid coffee for 2024. 5 Money Habits of Unhappy Couples. Saturday, February 24th. Richard Rosso and Danny Ratcliffe will have money tips to help revive your financial harmony. Register now at realinvestmentadvice.com. 5 Money Habits of Unhappy Couples. Candid coffee with Ratcliffe and Rosso. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
You're listening to The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
So my wife, is trying to get her house remodeled. It's been a standstill ever since late December. Like, nothing's been done. So I've been emailing the contractor saying, hey, what's up? What's up? And he's not emailing me back.
The Real Investment Show podcast.
So I emailed him. I said, I would advise you to give me an update as to what's going on because I'm going to refer this to my wife and you don't want to know that. And he didn't respond to me. So
we don't get something
unleash
by
the
3 o'clock
Kraken
today if you're listening.
Same show, your schedule.
Guess what? We had a response by the afternoon.
Oh, yeah.
And everything is now back on track and will be completed on time by the deadline.
At realinvestmentadvice.com.
It's FAFO, man. Don't make me unleash my wife on you.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show. So talking a little bit about, this kind of theme that I've been talking about the last couple of days. And again, we wrote about it in this weekend's newsletter, touched on it yesterday, a little bit more detail today because I have an article out about it on the website. So if you go to realinvestmentadvice.com, you can kind of see all the attendant charts and graphs. I didn't go through all of them. But just, this market is kind of reaching that point that we're going to have a corrective action of some sort. Everybody's on one side of the boat. Just everybody's extremely bullish. So the obvious question that I always get is, why don't you just sell and go to cash and wait it out? That's certainly an option. And if you want to do that, that's certainly okay. I don't recommend it because markets, when they're driven by FOMO, can last a lot longer than you think. They can do things that you don't expect them to do. So trying to go to cash is fine, right? You can do that. But this market's going to keep going up, and this market will go up longer than you think. And then you're going to go, well, I'm missing out. I got out too early because, dummy Lance told me to get out of the market. And now I've missed out on all these gains. So then you get back in, and that's the top, right? So that's the psychological pull of what happens in the markets. The other factor is that, trying to get out and wait it out is fine, but this market, as an example, I'm not saying this is going to happen, but, the market could go up 10% from here, correct 10%, you get back into the market exactly where you are right now, and that's okay, right? But you kind of spend a long time sitting in cash, and the problem is not knowing exactly when to get back in. So it's hard to time the markets, to get those actual peaks or troughs. You can do that. You can get lucky, right? And it's certainly possible, but it's difficult to do. And so this is why we just talk about managing risk. We reduce exposure, we'll raise cash if needed, but we try to let the market dictate. Right now we have buy signals on the markets where, yes, markets overbought, markets are extended, but they're still on buy signals. So there's nothing right now today that suggests we're going to have a major downturn in the market. So we need to participate with the market while it's going up. We need to make returns when we can. And then when the markets start to give us sell signals, then yes, reduce cash, reduce your overall risk, put on some defensive assets, however you want to manage your portfolio is up to you, of course. But, timing the market's always difficult to get it exactly right. And this is why, using a good set of indicators, we on SimpleVisor as an example, we've got 2 money flow indicators, one's daily, one's weekly, to kind of navigate these long-term changes. And those indicators aren't going to get you out right at the top. They're not going to get you in right at the bottom, right? You're going to miss the tops and you're going to miss the bottoms. And that's okay. That's okay. Reduce a little bit of risk, manage risk going up, market being correct, you get a sell signal, reduce risk more. When you get the buy signal, start working your way back in. So that's just managing the portfolio. But trying to time the market becomes very difficult. And this is where, as investors, we make a lot of psychological mistakes because historically, this is what happens is that markets start going up and you're out of the market. So now you feel like you're missing out, got to get in. So you're going to wait for a correction. Then the market keeps going up. So now it's even more overbought than it was before. So now you're going to wait to get back in. And then the market corrects a little bit. And you're like, this is the big corrections that come. I'm going to buy cheap. And then the market takes off running again. And you're just always kind of behind the curve. Same thing happens on the way down is that the markets are declining. It's like, this market is going to really go down. Like 2022 is a great example. Everybody was expecting this market to go down 30, 40%. We were down 19 at the end of the year on a total return basis. But all along the way, we kept having these big rallies along the way. So the market never really got really overworked. And every time the market did decline a little bit, everybody had so much FOMO about missing out on the next, bull market that they kept buying every dip. And so, you never got that real cleansing move in the market that would bring, say, now valuations are cheap, I'm going to get back. And we never did that. So for a lot of people that were kind of expecting that bear market, they never got back into the market. And this is the psychological thing that we do to ourselves is that we're always, expecting what's going to occur. And then as we are expecting, this is the way it's going to work out. When it doesn't work out that way, then we keep coming up with reasons why it's still going to occur. It just hasn't happened yet. So I'm going to wait. Eventually, the pressure of missing out gets too big and we have to get back in. And normally we buy in way too late. We tell you stories all the time about even recently within the last year, we've met with people that have been out of the market since the financial crisis because they were so worried that the market was going to have another big 50% downturn again. But, now 400% later, it's like, I got to get back in. I got to make some money. I'm getting too close to retirement. So that's the challenge, right? That's the challenge of timing the market. So sometimes it's very important that we just have to set those emotions aside. And, again, this is why we focus a lot on technicals. Again, it's not that we're technical investors, we're fundamental investors, but we use those technicals to try to alleviate those emotional biases that get us in so much trouble over time. And it's difficult. I mean, look, I'm emotional. I hate when, I'm missing, I'm not performing as well as the market, or I miss an opportunity. I see something and I don't get it bought at the right time. I'm emotional just like everybody else. And we try to combat that on a daily basis because the emotions are what get us more often than not. We get wrapped up into these macro views about things, the dollar or whatever it is. And so I don't want to be invested because, the dollar's about to plummet, whatever the reason is, but then it doesn't happen. And so we wind up missing opportunities because we're worried about this one big macro event that didn't occur, even though everybody was telling us it was going to occur. I mean, look, we've had numerous of those just over the last couple of years. We had the debts, the deficits, we got to issue debt and these big debt issuances of $34 trillion in debt and the dollar and all these things. And these were all supposed to cause an immediate impact on the markets, and they didn't. You had skyrocketing inflation, the Fed hiking rates, and the Fed, whenever the Fed hikes rates, data will tell you we always have a recession, yet we haven't had a recession. Markets are hitting all-time highs. Happens. Don't know why it happens, but it happens. And that's why it's important that we kind of separate out some of these macro views. And look, we were writing articles just like everybody else, right? Doing the analysis. Fed rate hikes, tightening monetary policy, high inflation, inverted yield curves, all recessionary signals, need to be aware of it. Markets just kept going up. Markets are going up and the Fed's tightening their balance sheet. But it's what's happening. So, we've had to participate even though all of our alarm bells are going off. Well, then that's when we kind of keep going back to these technicals. And that's the whole point of this article today is sentiment, technicals, those are the shorter term risk indicators to pay attention to. Those indicators suggest that this market's gone too far too quickly and we're going to have some type of corrective action. Not today. Maybe not tomorrow. Could be a week, could be a month, could be 3 months from now. Again, markets can remain illogical longer than you can remain solvent. But at some point between today and the election, that's your time frame, we're probably going to have a 5 to a 10% correction along the way. Could be sloppy. Could be no correction at all. Could be just markets going nowhere for 4 months. That would do the trick as well. Could just be a big rotation. In other words, tech sells off. A lot of other underperforming sectors, REITs, utilities, those type of things are performing better. Market just kind of goes nowhere. But we work through a rotation in the markets and we work off some of this excess. Then we can look at what the next leg of the market's going to look like. Who's going to be the leaders, who's going to be the laggards, those type of things. So again, this is the whole point of the article today. I just want to get across to you though, because again, I invariably when we talk about this, I get a ton of emails saying, well, again, as I said, if you think a crash is coming, why aren't you just all in cash and short the market? It's a bad idea. It's a bad strategy. Timing is very difficult. The other thing, though, and again, just want to reiterate this, is I'm not saying the markets are about to crash. I'm just saying we're going to have a correction, consolidation, normal, healthy. Now, eventually, we will have a much bigger decline down the road somewhere, but that's a different conversation for a different day. Coming out today, earnings-wise, we have Airbnb, AutoNation, Biogen, Coke was out this morning. Earnings were a little bit better than expected. Hasbro, Instacart, Marriott International, Lyft. Of course, Lyft is going to be interesting to watch after Uber. Uber had a really good report, and so it's be interesting. And Uber's been doing stock has been doing fantastic. So we'll see if Lyft performs the same. MGM, Moody's, Robinhood, of course, is the trading application for retail investors. So it'll be interesting to see if if all this kind of exuberance in the market is translating into more trading activity for Robinhood. Are the young, youthful speculators returning back to Robinhood after they left? That'll be an interesting report to watch. Something we'll probably talk about tomorrow as well with Danny. All right, come back. We'll wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Nothing sinks a marriage quicker than money issues. This Valentine's Day, promise you'll respect your lover's credit, communicate about your money, and share together our first Candid Coffee for 2024. 5 Money Habits of Unhappy Couples. Saturday, February 24th. Richard Rosso and Danny Ratliff will have money tips to help revive your financial harmony. Register now at realinvestmentadvice.com. 5 Money Habits of Unhappy Couples. Candid Coffee with Ratliff and Rosso. realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So I've been looking for a side gig, just something to do in all my free spare time, and found something that looks a little interesting. FBI Cleveland warns of romance scams. Yeah. So apparently, romance scams, also known as also known as confidence scams. That's a con man. You know the difference between a thief and a con man? Thief runs out of town. Con man walks. Romance scams, also known as confidence scams, continue to rise, typically occur when criminal creates a fake profile on a dating site or social media platform. Social media has made romance scams a lot easier because it's all anonymous, right? You can hide behind pseudonyms and fake profiles and fake pictures and everything else. And there's a lot of people out there that are on social media applications and looking for love, right? Everybody wants a little love these days. These criminals are actively searching dating websites, apps, chat rooms, and social networking sites in their efforts to build a relationship with the goal of accessing financial assets or personally identifiable information, which occurs quite often. You know, this is how these things start, is that, you know, they target somebody who typically, it's typically men targeting women, right? And it's women over 40s, divorced, widowed, elderly, disabled. Those are the kind of the prime targets, right? Because they're lonely in a lot of cases. And if they're divorced or widowed, they potentially have assets from either the divorce or insurance settlements, etc. So they're good targets. But these things start out rather innocently, and I'm telling you this for a reason. So just bear with me for a second. It's not I'm really looking for a side gig. Or love. Either one. I'm all good. But, you know, this is how these things start out, right? So they, you know, make a connection on social media. And this is something, particularly if you have elderly parents, to be well aware of if they kind of fall into that category. You know, if you're, you know, your dad's passed away and your mom's living alone, these are and it's not just dating apps, right? It's social media in general. particularly like they're on Facebook and, they make friends with somebody and they're chatting back and forth. And then it's like, oh, well, I'll come see you. Why don't you send me, but I don't have any money right now. I'm out of a job or whatever it is. Can you send me some money so I can get a plane ticket to come see you? And then they send them the money for the plane ticket, but then somehow the plane ticket never gets bought. And it just goes on from there. There's always a problem. And it starts out small, a couple $100 here, $500 there, $1,000 here, but it adds up over time. And we hear about these stories often. Right. And it's just becoming much more prevalent now as we get as the scammers become a lot more sophisticated in their actions. But technology is just moving so quickly. It's moving past a lot of our elderly parents and their ability to use them. I mean, like my mom, she's 87 and I can't get her to figure out how to text. So, it's, problematic. But, it's interesting because this was an article that was put out by it was an alert actually put out by the FBI in Cleveland warning of these romance scams. Perpetrators are, and this is from the actual alert, as Valentine's Day approaches, and again, by the way, today's the 13th. Tomorrow, gentlemen, tomorrow is the 14th. Look, if you haven't done anything yet for the love of your life and would prefer to keep living after tomorrow, swing by any Kroger's. There's a big white tent in front of every Kroger's across the country right now selling flowers, candy. Do something, right? I would like you to continue to be able to watch the show from the luxury of your own home, not the hospital. So, exactly. So, tomorrow's Valentine's Day. But this is the reason this alert came out from the FBI. It's talking about these romance scams on Valentine's Day. This is where it gets, much more prevalent. So, again, just kind of be aware if you have elderly parents that are divorced, widowed, disabled, etc. They are prime targets, and this is something that's just getting, much more becoming much more problematic around the country and across time as we go. So, just something to be aware of. I see, I get emails from people quite often that address this specific issue. My mom got wrapped up in this issue, or how do I fix it? And is there any recourse? And no, in a lot of cases, there's no recourse whatsoever, but you've got to identify these problems and get them shut down. And particularly if they're more elderly, starting to potentially lose their faculties a little bit, get added on to their bank accounts as a joint signer so you can at least track the activity, see what's going on, see if there's anything odd. It's just, it's unfortunate that we live in a society like that, but the more that we go digital, and this is the problem with digital banking, is it just opens up people to more and more abilities to get scammed, because it's easy for drafts to come out of accounts. And if you don't look at your account every day and are not tracking every little expenditure, it's easy not to catch some of these things because they start out small. One of the things that a scammer will do is, if they can get your credit card data, they will run small charges, like buy a pizza, things that you really won't notice initially, to make sure the credit card is valid. So you get a couple of charges that come through that are very small, they're innocuous. You go, I don't really remember ordering a pizza, but I guess I did. And then you get hit with the big charges, right? And so this is just things to, if you have elderly parents and they're kind of dealing with any of these issues, it's just something to be aware of. And again, there's just, particularly as we get near holidays like Valentine's, Christmas, etc., that's when these scams really start to pick up traction, because again, everybody's moving very quickly. You haven't done your Valentine's Day shopping yet, so get out there and do it. But everybody's moving quickly to get things done. This is a good time to just kind of make sure that your parents are getting taken care of as well. All right. So today, like I said, CPI, economists right now expect that consumer inflation is going to fall below 3%. So the expectation, right now is that we'll be at 2.9% on an annualized basis. There is some concern, though, as I said earlier in the show, that we could see an uptick maybe a little bit hotter than expected CPI because of rising gasoline prices recently. But again, we'll see. Again, food and gas typically get stripped out. The Fed looks at the core. So today, the one thing that would really spark a movement in the markets one direction or the other is a much hotter than expected headline print. But if the core print is hotter than expected, that could be bad for the markets, as it would delay any type of rate cut from the Fed, potentially even further. And again, the markets have already been trying to reprice in fewer rate cuts. But if that inflation number comes in hotter than expected, especially on the core side, that would certainly potentially kick out any type of rate cut by the Fed, just because of the concern of inflation resurging, right? That wouldn't be good for the markets. If the print comes in a lot cooler than expected, then that's going to be good for stocks, because, again, they'll be back to trying to price in more rate cuts. Economists on the Wall Street Journal expect Labor Department's monthly inflation report will show an overall consumer prices were up 2.9% in January from a year earlier. That's the smallest gain since March of 2021. Now, remember, this is year-over-year prices. Still rising, right? You don't have deflation. We don't have negative prices. We still have inflation running at 2.9% on an annualized basis. But inflation, the rate of growth of that inflation is slowing down. And I know you're sitting home like, oh, well, I still can't afford to buy groceries. I know. And groceries are still more expensive than they were last year. But the rate of that price increase is slowing down. That's what the Fed's looking for. They want inflation at 2% a year, not 3%. They estimate that, Wall Street economists, estimate that core prices, which exclude food and energy items, in an effort to track inflation's underlying trend, were up 3.7%. That's the smallest gain also since April of 2021. So still, near 4% at the core in terms of inflation once you strip out volatile food and energy. That's still not cheap. So it reports out at 7:30 this morning. and again, the rate of inflation is slowing. We're not at deflation yet. Still have inflation. And the Fed doesn't want deflation. They want 2% growth in inflation. So we'll see how the markets react this morning. Right now, futures are mildly lower. The Dow's down about 60, 70 points. Nasdaq's down about 117. Technology under a bit of pressure this morning. Again, not surprising. Tech has had such a big run. A bit of a correction there would not be surprising. And again, as we talked about yesterday, seeing a bit more of this rotational action occur between technology and some of the other sectors of the markets. We saw that a bit yesterday. Utilities did well. Mid-caps did well. We saw real estate do okay yesterday. Energy did great. The purchase of Endeavor drilling by Diamondback was a big move in the energy market yesterday. So, again, hopefully see a little bit more of that rotation, kind of cool this market off a bit. We're still kind of working through our profit taking and rebalancing. We'll continue that here over the next few days as well. If you have any questions, get by the website, realinvestmentadvice.com. Have a great day. See you back here tomorrow.